So, talk about good timing for a webinar here. A webinar on how to trade shares in equity CFDs a couple of days after we see the biggest one-day fall in US stock markets ever. Very good timing. We can obviously chat a bit about that towards the end. Any questions on what's going on, or where I might think things are headed from there? I can certainly get into that a bit towards the end, but actually it's not the main focus of today. Today we're kind of talking a bit more about generally what to look at for when you're getting into trading shares, and how it varies a little bit if you're more familiar with Forex, or if you're maybe more used to just a regular share trading account. What's a little bit different about trading CFDs. So that is our webinar for today, trading shares with LCG. And this is the kind of things we're going to be covering. So actually quite a broad range of stuff today, and I would say that this webinar is probably going to last maybe slightly longer than these webinars typically. Well, it depends. We'll see how it goes. But I'm thinking it's probably going to be slightly over the 30-minute mark today, maybe 40 minutes. There's a lot of material, but maybe I can get through it quick, so we'll see. But so it's, trading shares versus the other markets you might be more familiar with, Forex or indices or commodities, where to find the shares to trade. Obviously, that's everyone's first question. All right, buy shares, but there's obviously thousands of companies and associated shares. Which ones? Building a portfolio, that's obviously a little bit different from your average kind of day trading technique. You're actually kind of building up a group of shares to hold on to, and collectively you hope that they make money. Still, you've got to manage your risk in share trading. We'll talk a little bit about that, how you actually value a company's shares. Now, there are obviously a million ways to do that, but I'm going to talk about some of the more common ways. Dividends, a quick explainer on what dividends are, but more how are dividends treated when you're trading CFDs. Insider trading we'll look at, and then using a stock screener. That's one of the ways that you can screen out certain characteristics. For example, the size of the company, how many shares get traded a day, whether it's above its 52-week high, all these kind of little filters that you can screen out certain shares and give yourself a list to go looking through their charts and see if you've got some opportunities. And obviously, once you find those shares that you might be interested in, you can create a watch list. You can do that with the LCG Trader. We'll add a little bit of simple technical analysis. We're not going to spend too much time on that. It's good to complement some the kind of fundamental setup of the shares you're looking at with some technicals just to help your timing of the trade. But it's probably not as I don't feel like it should be as involved as using Fibonacci's and all the rest of it that you might otherwise do in Forex or futures trading. A little bit about the LCG analysis available. I'll recommend some websites at the end, and then we'll just talk about the kind of investing styles that are out there and just go over what we've covered in this particular webinar. So just a very quick one here. A quick look at the stocks versus Forex versus gold versus oil, maybe some of the kind of different markets available to trade. Now, this is obviously all a bit slightly different given the last couple of days, because the point is still broadly true, that you can see the red line here is the Dow Jones Industrial Average. And basically, of course, there have been some sell-offs, so this line is not quite up to date. There is a bit of a sell-off that's taken place. But broadly speaking, it's a bull market in stocks. That does simplify things somewhat, because in a bull market, you're really just looking to buy shares. You're not looking to sell them. If you contrast that, for example, with gold, it's been a much more volatile market. You want to be selling up here, but buying here, selling there, buying there, selling here, buying there. The direction you want to take on the market varies a lot more. Even more so with oil. Look at the volatility of this market, how large the swings are. If you sold it over here, it really depends on your timing of exiting your trade, whether you actually even took a profit for, even though you got the direction right. The timing, if you'd sold it up here versus here or even here, you know, you've got a very different outcome. You can see here the euro in the pink was in a kind of range trading conditions for a while. So, you know, buy here, sell here, buy here, sell here. And then it broke out to a bit of an uptrend. And then it kind of fell off a bit. And then actually this chart's not quite up to date. It kind of finishes at the end of last year. And we've seen a renewal of the trend again in the euro. So point being that when you get a good solid uptrend in stocks, it gives you a slight advantage over other markets just in terms of which way the trend is going. Yeah, the session is recorded, David. So yeah, if you want to check it out on YouTube or Facebook afterwards, it will be there. So if you want to get a bit more on the specifics of the kind of costs and the spreads of trading shares, specifically with LCG, with London Capital Group, check it out on this address right here. I'm not going to get into it at the moment. It's basically a table listing out all the kind of share costs that you'd I mean, it's very simple, but it gives out all the information all in one place for the different shares in different countries, etc. So again, to reiterate that other point, we've got a long-term rising trend in shares. Shares have risen over time. Now, volatility, this has been a hot topic over the last couple of days. And you see how I've got a little star there next to typically. Trading shares is typically less volatile than Forex. Now, actually, shares do tend to move a lot day to day, particularly when you have an earnings release or a surprise that, you know, the CEO quits, you know, you weren't expecting it. You know, you can see big moves in shares. But typically people will use no leverage, or if you're doing certainly more short-term trading, which is what people are a bit more orientated to do with LCG, then they've got a smaller amount of leverage. So LCG offers a maximum of 33 to 1 as of the time of this webinar. So that's about a 3% margin requirement on equities. So that is pretty favorable when you compare it to non-CFD accounts, which typically the most margin you'll ever use is 2 to 1. Obviously, the less leverage, the smaller amount of the bigger margin you put up for a trade, you know, the less risk you're taking, but the less potential return you have as well. So I hope that's all clear. Basically, Forex market does actually tend to move less on a day-to-day basis, but you tend to be using more leverage, so you see bigger swings in your account balance. Now, in terms of what LCG offers, we really only offer the most highly liquid stocks. So if you're interested in penny stocks, LCG, for the time being at least, is not the place to be. The idea here is that we're encouraging kind of very short-term in and out trading with low cost, and for there to be a low spread and a low cost, you really need an active market with lots of buyers and sellers. So if it's an illiquid penny stock with only a few occasional buyers and sellers, the spreads can get very wide, and it's not the business model we have. It's not to say it's a bad thing, but it's just not how LCG operates. For the share trades that you do have, we do have a dealing desk to ensure the quality of the execution on your stock trades. So things happen in markets. You know, there are obviously various capital events with stock splits and all sorts. You know, we have a team of experts here to kind of deal with all of that and make sure you're not get unfairly priced on your trades. And of course, the benefit of it is that you can call someone up and try and understand what's going on with your investment. Now, in terms of risk tolerance, trading shares are typically thought to be lower risk than Forex trading. As we've seen over the last couple of days, nothing is without risk. So, of course, share markets do go down. You know, you can obviously time your trade badly and you will lose money on that trade, theoretically. But the kind of trading you can do on shares is very adaptable, so you can day trade, and you can do everything from day trading penny stocks, which is very risky, very potentially lucrative, all the way to kind of a long-term buy and hold, which over the course of 30 years has proven itself over and over to be generally pretty safe. So trading shares obviously slightly different to the 24-hour markets like Forex and some of the commodities. They trade strictly within those exchange hours. So for the US, which is obviously the most active market and has been performing the best over the last few years, in terms of GMT, so that's here in London, it's 2:30 to 1. So quite good for trading in the evening, actually. Particularly during the open and during the close tend to be the most active times, just like in every market. So you can capture that close quite well after work. And if you're in Asia, for example, GMT +8, it's right there in the night into the early hours. European trading obviously is a kind of day job, if you like, trading European shares, 8 to 4:30 in London, and more of a sort of afternoon to late evening operation if you're out in Asia. So this is obviously a very common question. Where do you actually find the shares to trade? So again, there's a million different answers. I'm just giving you 5 of my favorite places to look for shares. I mean, number 1 and number 2 are very simple. Just because we have indexes of the biggest companies out there. As I said, LCG and also the kind of trading I concentrate on is generally the more liquid active stocks. And they move plenty. You don't have to search out, very illiquid, tiny company shares. Obviously, generally the smaller the company, the best growth potential they have. But then look at a company like Facebook. Or look at a company like Netflix. The growth rate of these companies is huge, and they are still big companies. So, you can find good companies to trade. Obviously, shares go in and out of shares, and sectors of shares go in and out of flavor all the time, and so you can move in and out of the different 500 top US stocks and do very well. The other place is Barron's, is like a classic US investors magazine in the US specifically. Here you can see that barrons.com/stockpicks. So that they have their own set of criteria for the companies that they think are going to do well. They have a pretty good track record, and also it's just very widely followed. So almost necessarily, if it's on the Barron's Stock Picks list, then it's going to be an actively traded stock. Which is generally what you want to see, those kind of big breakouts, etc. Now, something I'll talk about a little bit more later, the last 2 websites I put on here is Yahoo Finance. I hope you all use that to some degree anyway. Very classic but useful website. But the finance.yahoo.com screener is very useful, as is the FinViz screener, which is a bit more of an independent, less known site, but the screener is very useful. And all that it's doing is, again, screening out certain criteria above the 200-day moving average, for a technical example, a price-earnings ratio above 5, or whatever the case is for a fundamental example. So you can filter all sorts of different things. Obviously, in this particular webinar, I'm not giving you a list of 10 stocks to trade. That's more along the lines of just giving you tips, whereas this is more a way for you to find your own shares to trade. So the idea of a portfolio, building a portfolio, is slightly different to Forex trading. You may have a few trades running at the same time, but it's not exactly a portfolio of Forex trades. The idea is that they're all quite independent, ideally. You don't want to be going long the dollar in 4 different currency pairs, for example. You don't want to be buying gold against the dollar, the euro, and the Japanese yen. That's obviously quite undiversified. So similar concept, but really the idea is to buy shares as part of a portfolio, and the new aim, rather than for each individual share to win, or as many of those individual shares to win as possible, you're more just aiming for the portfolio to gain in value. Because at the end of the day, companies, even big ones, can and do go bankrupt. That's not a reason not to invest, but it is a reason to diversify. So you may have heard this phrase knocked around, asset allocation. That's almost like step number 1 in creating your portfolio. So, I mean, if you're talking about your broader investment portfolio, I mean, that could involve bonds, it can involve property, cash, obviously, any different fine art, any different kind of asset. They all kind of make up your asset allocation mix in your personal wealth portfolio. But obviously today, I mean, that's quite a wide gambit. Today we're just really more talking about equity portfolios, so 100% equities. So you should decide on the right types of shares to fit your investment goals. So I'm not going to tell you what they would be. Obviously, you have generally safer, long companies that have been in business a long time and they pay out a good dividend. That's a safer, kind of lower return approach. And then you also have the high growth companies where the growth could falter and you could see the shares drop and they don't offer any kind of dividend. So you're looking for the share price to keep appreciating. That's on the riskier side of things. So how do you balance those two is one consideration. So, we've talked a bit about that. How much risk are you prepared to take? You've got to be honest with yourself. Of course, we all want portfolios that go up 1,000% a year, but are you willing to accept, the complete loss of your portfolio to achieve that? Most people are actually not. So obviously, the expected return on the portfolio is going to be pretty comparable to the possible risk. So be honest with yourself. Are you going to be able to sleep at night if your portfolio is down by half, with the knowledge that it could double by the end of the year or whatever? And again, on that idea of diversification, we'll talk about some of the things you can use to diversify the portfolio in just a minute. But the general concept being here is that more diversified spreads out the risk. Less diversified means a bit more of a binary outcome, like the portfolio does very well or it does very badly if you're not very diversified. So if you've got a portfolio of the 10 top tech stocks, your portfolio is probably doing very well at the moment. It's not diversified at all. And when those tech stocks eventually fall out of flavor, then your portfolio is going to do universally badly. So ideally, your portfolio does slightly less well on the upturn, but you've got some balancing other sectors in this particular example that can perform better when tech eventually rolls over, sort of thing. And these things are all quite cyclical, so it's not like tech goes very well and then very badly. I mean, it will do well for a while, badly for a while. So it also helps to kind of draw down. So I was talking about the risk of your portfolio. Do you want a portfolio that goes, doubles in value, then halves in value, but then doubles in value again? Or do you want a portfolio that kind of has smaller drops? So, as an investor, generally you want lower volatility in your portfolio, right? You don't want it to drop loads. You want like a steady rising balance in your account, right? Ideally, it's less stressful that way. Being more diversified can help with that. Okay, so some ways to diversify. These are the obvious ones: country, sector, size, and growth versus defensive. And again, you look at some of these, you look through Barron's and they talk about these kinds of things. You do a little bit of research as to what a particular company you might be interested in, how it falls. You can split up lists of companies by their sector, by the country they're in, etc. So ideally, you've got a little mix of different countries. So you've got a kind of slight international element to your portfolio. You're investing in different sectors. So I've been talking about technology just because it's been doing so well, but tech, a little bit of tech, maybe utilities, in case there's a downturn, they pay a bit of dividend, that sort of thing. Size, we mentioned before that small cap blue chip, you probably heard those phrases thrown around. That's just capitalization of the company. So a small cap company is just a smaller company. So obviously, if it's smaller, it's got the potential to eventually one day be a big company. So it's got a lot more growth potential, but it's more risky. A blue chip company, it's one of the big mega companies. It's already big and mega. There's only so much bigger it can get. We have seen some mega mergers over the last couple of years. So there's still opportunities there. but typically you buy those more for the dividend, not so much for the appreciation in the share price. And that kind of growth versus defensive idea, you know, a lot of it relates to the size of the company as well. And there are certain sectors that typically do well when the economy is doing well, and there are certain sectors that do better when there's you know, a bit of a recession going on. So that is an important kind of mix to consider, and you can obviously vary how you've diversified your portfolio according to how you generally think things are progressing. You know, probably ideally, we're 10 years into an economic recovery in a bull market. I mean, this has been the case for a few years, so you'll have missed out on some returns, but you probably want to be edging towards a slightly more defensive portfolio in anticipation of some sort of eventual downturn. So I would say you probably want to hold at least 10 different shares in your portfolio, but probably not many more than 20. That does tend to be, you know, big investors like Carl Icahn. They have about that, and it's quite concentrated, but at least it kind of concentrates your mind a bit. If you have too many shares, yes, it's diversified, but you can't, you know, how much time do you have, especially if you're not a professional investor, to monitor all their progress and what's going on with their companies? But also 10 just provides you that just about enough in terms of diversification. Of course, they can't all be winners. That's why you want more than one. More shares makes diversification easier, and then obviously there's the kind of risk management element. You know, got some shares that do well in certain scenarios and certain shares that will do better in other scenarios. You're kind of managing your risk for the different scenarios. This information's a little bit out of date, but actually the trend is still pretty. It's still along these lines. This was, you know, this was sort of 9 months or so ago now, but just 10 companies, which obviously are mostly technology companies, were responsible for half of the entire S&P 500 rally year to date. So in May last year, tech, these 10 companies, if you know, they made up half the entire 500 company index gains. So gains obviously can be very concentrated in a certain number of companies, but again, it's not a reason for me, at least, still not to have a more diversified portfolio. But it's just good to be aware of the dynamics in the market right now. You probably do want some exposure to tech, even though it's been going on for a long while, this rally, just because it's dominating so much. So risk management, let's just kind of, it's a very simple way of thinking about this. For example, if you have a $10,000 account, 10 stocks in your portfolio, and it's good to think about this in terms of leverage, particularly because we are talking about CFDs, where you've got the option of using the leverage, the full amount of leverage, 33-to-1 in some cases. With no leverage, basically means you've got 10,000 in your account, you can invest 10,000, right? You can't use margin and invest 20,000 or more, for example. So 10% of your account into each stock, so obviously 10 stocks, 10% in each, $1,000 invested into each. Simple, right? If your stock doubles, so you've invested $1,000 in it, obviously if it's doubled in value, you stand to make $1,000. If it completely evaporates, the company goes bankrupt, you stand to lose $1,000. So that's your kind of risk to reward scenario, put very simply. It's not often you'll see a stock double, and it's not often you'll see it drop to zero, but just to give you a full flavor of like the possible scenarios here. If you're using 10 times leverage, now things change a little bit. You're not investing $10,000 anymore, you're investing $100,000. So with $10,000 invested into each stock, if the stock rises by 10%, you make $1,000. So obviously in the other scenario, you needed, when you didn't use any leverage, you needed the stock to double to make $1,000. If you're using leverage, you just need it to rise by 10%, and you double that $1,000 initial investment in terms of the cash that you had in your account. But if it falls by 10%, you lose $1,000, so you basically lose that entire cash investment about 10% of your portfolio. So you can see the kind of the risk-reward difference here in terms of the amount of the shares you buy relative to the size of your account. Now, moving on now to valuing shares. So, of course, you know, what you ultimately want to do, right, is choose a company that deserves to be valued more, right? You want to see a company that you think will be worth more in the future, and something that the market undervalues. They're the kind of two things that you want in your share price, right? So those two things together should help the share price go up. Because at some point in time, the market's going to realize it's worth more, and at some point in time, the company's going to earn more and do more exciting things, etc. So some kind of basic exercises to understand how is the company doing, number one. So it's earnings history. Now, this is simple enough, and again, it's on Yahoo Finance, any other website like that. Are the earnings growing or falling? Now, you can look on a quarterly basis to kind of grind down on it a little bit, particularly if it's US companies. UK companies more generally report on a half-year basis. Or you just look at the annual earnings. I mean, you do want to go a fair bit back. You probably want to go back 5 years or so and just get a general flavor for the trend of the earnings. News stories, you know, this is something, again, if you're tracking a certain company, or this may be a reason that you initially get into to get interested in the company in the first place. Is it producing some kind of new product or service that you think will find a lot of demand from its customer base and obviously generate the company some earnings? So that's more like looking at the actual nature of what the company does, and is it doing something new and good that can increase its earnings? And its share price performance, obviously. No, I'm not telling you there are different ways of thinking about this. Their share price could have been dropping. So obviously, when the share price drops, the general idea here is that you buy low, sell high, right? That's how we make money. But generally, shares are dropping for a reason, right? Because no one wants to hold those shares. They're selling them. So that's a fine balance. Or, you know, your criteria could be actually that the shares are already rising, people are already starting to like these shares, and you just think they're going to rise further. So different ways to interpret that. And then how does this compare with the market as a whole and versus the rest of its industry? So what you can actually do is, you know, this particular company, is it producing some new products and services? How does that compare with the new products and services that its competitors are producing? And then generally, when you're looking at the share price, the shares may be going up. Are they going up less than the overall market? So if you're looking at a UK company, are the shares rising quicker than the FTSE 100? Or are they rising, you know, slower than the FTSE 100? You know, it gives you a general flavor as to how the market currently views those in the context of the overall market environment. And this is just one thing you've got to think about with shares. If the overall market's rising, you generally want to be, you know, buying shares. If the overall market's falling, it's not such a great time to be buying shares because you've got that kind of general flow going against you. So, and then the other factor, number two, is how does the market view the share price? So what we like to do is look at these important yardsticks, if you like. So whether you can see whether the company is what you'll often hear undervalued or richly valued. Generally, where we find ourselves at the moment is that the overall stock market's quite overvalued. So you would imagine that over the next 5 years, the expected return of the stock market would be less than if the market had just dived and was due a recovery. That's just the nature of the beast. Part of what you look at is PE ratio, dividend yield, and there are some other things as well. We'll cover those main two, but there are some others, the acid test, pre-tax profit margin, return on capital, and depending on different industries, banks, for example, have all sorts of ratios you can look at to kind of value the shares. I'm not going to go in depth into all of those, just as I think it's not the appropriate webinar for that. So this is the PE ratio and dividend yield. These are two things I typically look at when investing in a company. Again, you can set different, you can look through, like anything in trading and investing, it's best to kind of look and do a kind of back test as to what's worked. When a company had a PE ratio of this, how did it do over the next 12 months? Get a general feeling as to the kind of companies you're interested in. Is there a trend? Is there a kind of general level in which the PE ratio should be a certain number for the shares to be worth investing in? But what the formula is just the share price divided by the earnings per share. So obviously, when a company earns $1 million and they've got 1 million shares, it's they've earned $1 per share kind of thing, and then the share price divided by that. Generally, the way to interpret this PE ratio is it's got a high PE ratio, the market expects high growth. If it's a low PE ratio, the market expects low growth. Now, if you're buying a low PE stock, obviously what you're trying to do is kind of outsmart the market. You think the market undervalues this company, and you think that over time this company has something to offer, and you're going to outsmart the market because this PE ratio is going to go up, namely by earning more per share and the share price rising. Conversely, you can buy companies with a high PE, and you just you're going with the flow. The market expects high growth. You're not going against the market. You're just buying into that growth story. And then next we've got the dividend yield. So obviously, really only applies for companies that actually pay a dividend, obviously. But you've got that annual dividend that the company pays divided by the stock price. So it's kind of the way you want to think about this is that high dividend yield is a company that pays high income relative to the market view. So it's almost like, question, the market thinks the company is going to do this well based on its stock price, but it's paying a very high dividend. Now that's, there's again different ways of interpreting this. But a low dividend yield is a company that pays low income relative to the market view. So, you can see a low dividend yield and think that they're going to start rising the dividend because the market view is kind of stronger than they currently pay. Or you can kind of look at the high dividend yield and think, well, actually, this market doesn't view this company too well, but actually they paid a pretty chunky dividend, and maybe the price can even go up too. Any questions on this, guys, obviously just let me know. And any questions, if you're watching the recording, obviously chuck a comment in the video. That'd be happy to help. So a little something on specifically on dividends here, dividends on CFDs. Now, a dividend, we talked a bit about them, obviously. We'd basically just, it's an amount per share that the company will pay out to investors at a certain date in the year or in the quarter. LCG will adjust your account for corporate actions, including dividends, stock splits, and other things. So these adjustments show up in your account as a transaction. So in the case of a dividend, you'll see a positive amount added to your account. So the idea is, when a company issues a dividend, it has an ex-div date. So obviously a company's going to, the share price is going to be worth more when you're able to receive this dividend. Past a certain date, you're not eligible to earn that dividend anymore, so the share price should be worth less, right? And so the share prices drop on the ex-div date typically to basically by about the same amount as the dividend payout, to just adjust the share price for that dividend. So that ex-div date typically happens about a month before the dividend is paid. So when the stock goes ex-div and you see that price fall, LCG will adjust for the amount of the dividend. So we're basically making an adjustment to your position to make up for this price change, which adds up to the same thing as getting the dividend. But because you don't actually own these shares, you're buying a CFD on the shares, you don't get paid the dividend. So when it's the divvy date and all the shareholders being paid, if you're wondering why you've not been paid the dividend, well, you were just given this adjustment a month earlier, which ultimately adds up to about the same thing. So a little bit on insider trading, not the illegal kind. So the idea here is that insiders are employees or directors of a company who regulators force to file a report every time they buy and sell shares. Basically because these insiders, they know the most about the company, right? They know what's going to happen next with the company more than anyone outside the company is the theory. So the trick is to find insiders, as I said, who know their company best, that are buying lots of their company's stock, because that shows sign of confidence in the company. Now, obviously nothing's perfect. There are instances where, investors are doing, insiders are doing something criminal at the company or something, and they're buying up the stock with their criminal proceeds. I mean, nothing's perfect as an indicator, but in general, it shows some good confidence if you see the CEO especially buying. So there are many reasons that insiders may be selling a stock. So there will be insider selling as well, but it's just not such a good signal that the insiders have lost confidence in the stock. It can mean that, but oftentimes, they're just people. They need cash. They've got their cash tied up in the shares. They sell some shares to buy a house or pay back a loan or whatever the case is. So it doesn't mean they don't value the company. It just means they need some cash for whatever reason. They have to cash out their stock. So it can be a contrarian signal, because investors will typically buy when the price has fallen, but they know their company has good prospects, and sell it when it's risen to take profits. So it's often the insiders are going against the general flow of the market. The shares may be falling, but these investors start buying because they believe that they know their company and what the company has planned, and they're taking advantage of that lower share price, which is obviously, again, falling into that general mantra of buy low, sell high. If you want to find some info on the insider ownership on the SEC's EDGAR database, the SEC is the regulator in the US. This is the address right here. So this is basically where they have to officially make that that report that they've been doing the buying and selling. So these are the websites I mentioned. We've got just did some screen grabs of Barron's, the StockPicks, and Yahoo, the screener. Definitely encourage you to check those websites out in terms of finding companies to trade. Once you have picked out some companies from those lists, often the time is that they meet a lot of the criteria, but you want to time the trade right. So you're not necessarily buying them right there on the spot. You can, obviously, but oftentimes what you want to do is put them in a watch list, wait for them to meet a certain price criteria, then buy them. Or obviously, even if you have bought them, you want to monitor them. So you can do that all within the LC Tree Trader under this watch list that you generally see pop up on the left side of the trading platform. Excuse me. So adding technical analysis. So again, with this idea, if you've got some companies that all fit your criteria, you put them on the watch list, but what are you looking for to buy them? Well, ultimately in technical analysis, there are kind of two techniques here. Waiting for a pullback to buy the drop, or wait for a breakout. So this simple diagram here just kind of demonstrates both, right? The shares have been trading sideways, for example. Something looks good, they're releasing a new product, earnings turn out well, or whatever the trigger is going to be for them to move out of this sideways motion and become more valuable shares that you want to buy into. You either wait for a break of these peaks, which make the resistance, or once the trend is already kind of going, you're looking for a time when the shares have just pulled back a bit. And, obviously a period of big enthusiasm sags a bit, and some profit taking, but the outlook still seems good. And here you're just buying at the old resistance, which becomes the new support on a pullback. So, I mean, there are all sorts of different investing styles, different ways of investing in shares. What I've highlighted at the top here, the momentum trading and growth trading, that's a little bit more the kind of orientation, I suppose, that I've put this webinar towards, because it's a bit more of the kind of trading style rather than an investment style. If you're value investing, again, it's where you're buying like a low PE stock and you basically think the market's undervaluing a company at the moment. The share price is low by historical standards, and you think it's going to rise up again. Generally, you end up being too early for these in value investing shares, and the stock will probably continue lower. You can't ever time these things perfectly. And it will just kind of hover around for a while, and you have to hold on to these shares for a while. And because the share price is low and you're anticipating it to rise, you still have to wait out that long rise as well. So that's a kind of a longer term process. Buy and hold, obviously very much the same thing. You're holding your portfolio for 10, 20 years. It's maybe you're adjusting it along the way, but it's kind of a longer term approach. Asset allocation, some people just purely change how they allocate the assets and buy ETFs, for example, exchange traded funds instead of individual shares. You can invest just purely for dividends in very safe stocks, or you can do these contrarian trades where everyone hates a stock but you buy into it. It's a bit similar to buying to value investing. You obviously do penny stock trading, where there's a lot of market manipulation in penny stocks typically. So a lot of people will short penny stocks after there's been a big ramp up through some market manipulation. You then short the penny stock back down again, or you try and participate in that rally up, which is generally not too genuine. It's just a bout of speculation, some insiders driving the price higher, and then it eventually crashes back again. Or you can do this kind of passive investing, just, you have your pension fund at work. These are all ways of investing and using shares, but they're not really what we've looked at today. What we're typically looking at is companies that are starting to grow or are already growing, and we're looking for opportunities to jump in on that growth. And generally, what you want is some momentum in the shares. You want the shares to pop to trade higher. So you want to trade in before the pop happens, on a dip maybe, or on the breakout halfway through the pop occurring. So these are the kind of strategies that we've covered a bit more, and probably something that using CFDs is a bit more orientated towards. So just a bit of extra reference here. Some of these are some of the sites I definitely encourage you to do a bit of your own more research on. For data, just in terms of earnings, price history and things, is Yahoo Finance, Barron's, pretty hard to beat. For charts, I like these two companies, two websites. They're both free, barchart.com, stockchart.com. You can do all sorts of comparisons between different company shares. Got most of the big shares listed on there as well. And it's actually, and break it down by sector and all that sort of thing for you to compare what's doing well and what isn't. In terms of price, excuse me. Obviously, when you're first getting started with investing in shares, it's good to read some other analysis. Eventually, you want to be just making your own decisions, but to get a feeling as to what other people are doing, I highly recommend seeking out from Zacks in terms of analyst reports, both free. I'm just mentioning free stuff here. For news, Financial Times, you actually do need a subscription, but it's very good, particularly for UK shares. CNBC, typically free, although I think they have subscription services. Well, they definitely do have subscription services as well. But all for the latest news, you'll pretty much be able to find those on those websites. And last but not least, obviously, in terms of LCG, we've got most of the big company shares out there. Our analysis generally tends to cover the indices, the forex, the commodities, and the broader swathe of what's happening in markets, but we certainly do earnings previews and the like, and we'll often respond to client demand for specific analysis of specific company shares. So get in touch with your account representative about that, or obviously let us know through social media, etc. If you are interested in some particular area of the market. We're always happy to try and accommodate if we can. And that's all available on the analysis and education page on the lcg.com website. Thank you very much. How did we do in the end? We did go a bit over. I thought we might. So it's been a longish webinar. So I'm glad you all stuck with me. Thanks for that. Might be easier if you're watching the recording. You can have a tea break in the middle. But I hope that was useful information. Obviously, all kind of good starter stuff. But I think there's some stuff you can take away from this and start having a go. Do a bit of a few demo trades or small live trades in the share market and see what you can do with it. All right, thanks very much for watching, everyone. It's Jasper signing out, and good luck with trading for the rest of the week. Cheers.